Semiconductors just flipped from leader to laggard as flows rotate hard into defensives. Our sector rotation model clearly shows what is going on in markets. Sector strength versus SPY. Technology has become the weakest sector of all. The ones pointing up currently are mainly defensives, such as energy, communications, real estate, healthcare, and staples. Let's have a more detailed look inside the technology sector. Here we see that the former driver of the extreme spring rally is now the biggest loser. Semiconductors and hyperscalers are dragging the whole market down. Is this the AI bubble bursting? Well, one thing is for sure, the massive investments they made are bigger than the household of some entire countries. And it becomes more and more uncertain that they will pay off in the end. For all of them, as AI models become cheaper every day and new ones grow like mushrooms, especially in Asia. The S&P went on a dive yesterday, however. The yellow bars indicate that the number of stocks closing above their daily 20 moving average actually increased. This indicates that the breadth the market broadens has improved. Only some heavyweights are dragging indices lower. The market is broadening. Money still flows into stocks, but into other sectors. Market breadth captures this shift away from semiconductors and the Magnificent Seven toward other stocks. Smart money is accumulating in 4 key sectors: energy, utilities, healthcare, and real estate. These sectors are all defensives, issuing a risk-off signal. Here we see the average 4-year seasonality of the presidential cycle. The midterm year is the weakest of all years. Although we've seen exceptional gains so far, in very few sectors, we have to mention. The period from now until the midterm elections in October appears to be extremely weak. Choppy sideways markets could lie ahead of us, provided that we don't see any black swans popping up. Also, this is possible, given the current escalation in the Far East. Yesterday's sell-off came with an exceptional ETF flow pattern. Normally, inflows into technology and growth ETFs dominates other sectors, sometimes even by orders of magnitude. Yesterday, massive inflows went out to healthcare, real estate, staples, and energy. Following the ETF inflows might be good advice. Statistically favorable trading patterns have emerged in exactly those sectors. The Markov model sector outlook, based on the current pattern distribution, points upwards for exactly these sectors: energy, healthcare, staples, utilities. With our stock screener, it is very easy to surface the bullish patterns in leading sectors. The heat map allows a quick comparison among peers before a detailed analysis of the chart itself is offered. Let's have a look at one of the healthcare leaders, AbbVie. After a long sideways consolidation since 2005, in recent months AbbVie formed a cup with handle and, on a massive green candle yesterday, resumed its uptrend. This breakout followed a volume spike linked to a confirmed dark pool trade on June 6 and a series of call option inflow days. Earnings will take place on July 31st. In our analysis chart, you get all the important information presented visually and intuitive. Patterns are always evaluated statistically and presented with clear entry marks, stop loss, and take profit leaves to make your trading decisions easier and less descriptive. Trade with an edge, not with a good guess. Never trade stories, unless you want to become the exit liquidity of the storyteller. This is the short-term general market outlook, calculated by a model which takes into account all our single indicators. It points to further weakness amid possible pullbacks. Stay cautious and reduce risk over the coming days and weeks. Current opportunities are mainly in single stocks and defensive sectors. For deeper charts and daily signals, visit markets in Vitro.